The reason that thinking out 100 years makes sense is because when you think out 3 generations, it's very clarifying and it allows you to avoid all the noise and all the confusion and all the sound and fury. And everybody wants to like wave smoke and mirrors in front of you and get you to juggle razor blades and shock and awe you. Everybody's going to always try to get you to panic. They're always going to basically fudge you. They're going to say, oh, this is not safe. That is not safe. And their goal is to get your Bitcoin from you.
So now we have the Fed on watch still. They are not going to ease. Their finger's still on tightening. ECB, Bank of Japan, and Bank of England, all still probably done tightening, but they're not even started easing. That's been my iteration. Let's get to the first bridge of the start, take out that priced in tightening, and then to start easing. Then we can think about when risk assets will bottom, and they're just getting started. So reiteration from our economics team this morning, Bloomberg Economics. The recession will hit by the end of this year.
The difference between 14% and 7% is the difference between your $1 million becoming $1 billion. At 14%, your $1 million becomes $1 billion of purchasing power, right? And at 7%, your $1 million stays $1 million, right?
Exactly.
Do you want to double 10 times in a row? That's 14 versus 7. Or do you want to basically break even 10 times in a row every decade? So ultimately, you can get excited in the near term about hyper growth Bitcoin, the 40, 50% Bitcoin, that's hyper growth. And I can give you a dozen reasons why it'll continue to grow more than 14%, over the next decade or so. But the reason that thinking out 100 years makes sense is because when you think out 3 generations, it's very clarifying and it allows you to avoid all the noise and all the confusion and all the sound and fury. And everybody wants to like wave smoke and mirrors in front of you and get you to juggle razor blades and shock and awe you in order to get you to give them your money. It's like, for example, if you were the royal family of the UK and I said, oh, there's a pandemic in London, but there's no pandemic in the middle of this island in the Atlantic. So I will trade you 1,000 acres in the mid-Atlantic for the center of London and Buckingham Palace, and Chelsea. Would you trade in a panic? Because if you did, when the pandemic ends, you would realize that you own something worth nothing and you gave up the middle of London that was worth $100 billion. And so that's why everybody's going to always try to get you to panic. They're always going to basically fudge you. They're going to say, oh, this is not safe. That is not safe. And their goal is to get your Bitcoin from you. They may not even realize they're trying to get their Bitcoin from you, but they want to be relevant, right? What I'm saying is you own the most desirable thing in the universe and you lock it away and you wait for 100 years and your family is rich. And if that's the case, then why would you ever watch their television show? Why would you ever give them your money? Why would you ever pay them a commission? Why would you give them a 2% management fee and a 20% participation? Why would you buy their altcoin? Why would you buy their stock? Why would you hire them to give you advice? Why would you read their writing? Why would you listen to their video? It's like, you don't really need to do any of that if you just buy Bitcoin and hold it. And so that's why the rational thing to do is think like the Emperor of Japan. I mean, haven't they like owned the middle of Tokyo for 1,000 years or something? Or think like the King of England. Don't they own the middle of London for the last 1,000 years? And if you go look at the royal family in the UAE, it's illegal to buy beachfront real estate in the Emirates unless you're a royal. They won't just sell it to you. And it's because smart people realize that you should keep the high quality property for the next 100 years. You can't go buy the middle of Central Park, no matter how much you bid. I can't buy it for $1 billion an acre. The city of New York will not sell it to me because they're thinking out long-term. And if you had sold Central Park at any point in the past 100 years for any amount of money within reason, for a 200% premium to the going rate of real estate, it would have been a mistake, right? It's always a mistake to sell the good thing and buy the average thing or the conventional thing.
One of the worst performing assets last year was GBTC. It's one of the best performing this year. I still bullish that asset, but TLT has been one of the biggest surprises, particularly here. Guilty, wrong. I didn't think long bond 10 years ago about 4%, but now they're 5%. I think they're going to drop on the elevator towards 3% with the deficit ballooning, with QE that you mentioned. Now that's a bridge to come to, and then it's after that I don't know what's going to happen. We're going to unfortunately, we might get austerity. Republicans coming, they're talking austerity already with the new Speaker of the House. So what does that mean? That's a depression. And that's kind of what they did in the 30s. And we raised taxes, and we had Smoot-Hawley Tariff Act and things like that, but we're tilting that way. So in the macro right now, I think this is pretty significant that we're seeing this asset that's 3 times the volatility of the stock market and gold, Bitcoin, doing well when everything else is tilting lower. Now, the key thing about the stock market you have to look right now is, yes, 14-day RSI is oversold. When have you ever seen a bear market that doesn't get oversold? And this is historic and epic. And the key thing I want to point out in my presentation is never forget where you came from. And it's a simple fact that if you use a simple Warren Buffett model versus the S&P 500, just a year ago was the most expensive since 1936. We're just simply reverting the most historic period in history of low interest rates. The facts have changed. Okay, and here we are working on a day-to-day. Everything that's a risk asset is supposed to go down in the environment, and that's why the federal government is part of the problem now. They've borrowed so much, we're at the limit now. And you mentioned, Dave, at some point there's going to be QE because the Fed can do it, but they're going to have to. And also, a lesson I learned last year, I remember with some of my colleagues who were bullish crude oil right before the midterms. I'm like, don't underestimate what the world's largest producer, what helps get a sitting electors, politicians elected. They need lower crude oil and things like that. So expect pretty strong austerity, not austerity, but priming the pump. And at some point, this is epic, but this to me right now, the situation I see around is very akin to 1930. Stock market went down 50% in 1929, rallied 50% and rolled over, and everybody thought it was over. All the indicators we have, it's just getting started. That was just the warning sign. So the key thing is they're supposed to issue 3s, 10s, and 30s securities, 114 billion. And if they issue a little bit less 30 years than the market anticipates, which I think they will, that will give you a signal that, okay, well, we're starting to focus on this spike in long bond yields, and we think it's serious. And we'll see what happens. But right now, the market's already expecting that. I mean, it's expecting the supply. The key thing is when the supply comes on, if it spikes yields shorter term, that's just a black hole for risk assets. You see the lose-lose here. The Fed's going to keep borrowing. The Treasury is going to keep borrowing. And at some point, it's just going to be overwhelming when people realize, okay, well, these yields are just too attractive, and I got to lock up and protect myself. And every time they inch higher, I pointed out what happened with the 2-year note, above 5%. All risk assets, they just have that ceiling, that wall of resistance above them for this massive need for borrowing from the safest risk assets on the